crack on.
Yeah.
Okay. Well, welcome everybody. Thank you very much. It's greatly attended, of course, and apologies for the cramped room, but welcome, retirement, wealth after work. Reid from New Zealand Funds and Jordan will present about retirement and what they can offer and parts of things they have, etc. Would you crack into it, Reid?
Okay, brilliant. Thank you. Thank you, Ron, for coming along and putting time aside on your Thursday afternoon. I'm sure there's lawns to be mowed and other things to be attended, but you've taken time out of your day to come along and hopefully get some really, really good insight and tips and ideas around your own sort of personal space and how you think about retirement. And this session, gratefully joined by Jordan, who's one of my advisor colleagues at NZ Funds as well, who's a bit more of a Franklin local than I am. But today, let's make it a really open, engaging session. It's really important. I've been told the dumbest question is the one that was not asked. So lots of dumb questions and pointy questions. Let's make it really engaging. Make sure you get lots out of it. And really, I think to give you a bit of background as to what we'll cover, it sounds like an obvious question, but why planning for retirement is important. The value of getting high quality advice at the right stages around those significant milestones, how to not make it too complicated, how to invest simply and make the most of what you have. And also I thought we'd chuck in a bit of KiwiSaver stuff in there as well, because for a lot of people I imagine probably for a lot of your clients in particular, Jordan, it's not well understood what happens at retirement for KiwiSaver.
Yeah, I mean, it's so new, so a lot of people don't really know what it's doing, and now we're seeing quite substantial balances all of a sudden, and people are thinking, well, now I need to focus on what my KiwiSaver is doing, because it is a means of retirement income, whether it's not the main one. But yeah, that's all my job is to talk about clients' KiwiSavers and see why it's actually important and what it's doing for them even past retirement. So that's what we focus on.
Brilliant. And lastly, if we've got time, so we're shooting for about 5 o'clock finish. Is that right? We've got time. I'll take you through our financial planning software called WealthPlan, which helps us to kind of take all this abstract theory and ideas and kind of put it into something a bit more practical, visual. Plenty of time for Q&A, and Hunter Withers and Andrew particularly going to have a bit of talk about succession planning, because it's one thing to want to retire, but you need a path to get there, particularly if you're in business or with them. So let's get past that. So who are we and why are we, what sort of experience do we have in helping clients with retirement? NZ Funds are a fund manager of about 38 years now. And in 38 years, lots of companies have come and gone. Lots of wealth management firms in that time have come and gone. But importantly, 37 years gives you an opportunity to work with some clients for 37 years. So they have often started with us in their earlier earning years, in their 30s and 40s. And now many of them are retired. So we've been able to work with them through multiple decades and markets to help them serve out our retirements. And we've learned a lot about how to get them well for that. Most of our clients have been with us for more than a decade, which is neat. It means they've seen, odds are good, they've seen 2, probably 3 or 4 really good years, a couple of disappointing years and a couple of horrendous ones as well. But they stay the course. And there's about 30,000 clients across the country. It's not just myself and Jordan as advisors. There's 20 other advisors that burn across the land. We look after about $3 billion for ex-Kiwis as well. So it's a privilege. And, particularly Jordan in her space, looking after her KiwiSaver clients, about 25,000 of our total clients are just KiwiSaver members, which is great. Often starting their savings journey. So the obvious question, why is it important? 80 people a day are turning 65. And that is a huge, as we know, it comes up in media every 3 or 4 months. We do have a growing population that are over 65, and that just continues to balloon. So there's about 17% of our population now are, retired, are 65, and that is likely going to double in the next 20 years. So, so it's real, it's coming. For those of us who are fortunate enough to make it 65, it pays to be prepared. And some less than exciting statistics. A lot of Kiwis, if it's 2.5 or 2.8, just they don't know if they're in a position where they can realistically afford to retire. And it's something that I take huge amount of enjoyment in helping these clients better understand, are they on track to fully fund their retirement? And if they're not, how can we help to close that gap to make sure that they've at least got a plan in place and they know what they need to do in order to get to that milestone. But if there's any, don't give me just rattle on. So if you've got any questions, let me know. You probably cover this bit off. Feel like Jordan?
Super. I mean, like we run in the room knows what the New Zealand Super is. The stats on the board are pretty self-explanatory. So on average, the median earnings for Kiwis is about 71,000. You'll then look over to the Super and see that the Super on its own is not actually going to cover that full number. If we think about the Super, it's really there for those basic needs in retirement. So continuing with a lavish lifestyle, if that's what you live, there's still a bit of a gap. And so, like Reid said, how we fill those gaps is really important. Again, my focus is on KiwiSaver as one of them, because it is becoming a lot more important. But yeah, as you can see, as a single person, it's about 32,000 you're getting annually. So it's just over $500 before tax a week, paid fortnightly though. And then as a couple, it's 49,000 a year. So, I mean, you can see the gap on the board. It still is one. And so it's really about reassuring clients or yourselves how you can get there, because you don't want to reach those retirement years and think, what am I going to do with that gap, if you will?
And we've got some of our older clients in particular, they live really, comfortably is not popular, right word. They live simply and frugally off just the superannuation alone. But if you want more choices in life, then certainly being able to, top that income up from different places is vital. So why get advice? We're what is it? DIY is now DNA. It's not in mine. I'm sure a lot of you look pretty handy. Why get advice? Because generally, those that get advice are likely to enjoy a slightly higher investment return over time. And I put a lot of that down to just making the right decisions during the right markets. And over a lifetime, you compound that, it can result in dramatically more real savings. Having failing to prepare is failing to plan is planning to fail, right? So that's sort of the advice, the component that the value that we bring to the table. And this is how we do it. There are lots of other really good fund managers, good financial advice outfits in New Zealand. Often it's really good to step back and take a really big total view of your wealth, because there's lots of little aspects of it. There's a home, maybe there's a second home if you're really lucky, maybe there's a few shares in Contact Energy or Ryman, maybe there's an old legacy insurance investment policy, maybe there's inheritance, maybe there's a classic car that you plan on selling at some point. So taking a total view is a good start point. What we try and do is we take that position and we model different scenarios around how you could use these different bits and pieces to help fund your golden years. then, in the instance where clients want to entrust some of their wealth to us, we create an investment portfolio for them, bespoke to them and their goals. And then we review that on a regular basis, because you can set and forget things, but you do run the risk of being poorly invested through at the wrong time in life. So do you want to cover this one, Jordan? How to optimize and invest simply?
I mean, so sorry, so we want to enable your wealth to last as long as you do. So that's mixing the way you're invested, if you will. I'm sure you can imagine if you're 18 years old, your risk profile might look a little bit different than now, because you have the time frame to do so. So what we really focus on at New Zealand Funds is we take something called a life cycle approach, and this is particularly in our KiwiSaver again. But with that life cycle approach, it's really on the idea that up until the age of 54, you have quite a large risk tolerance, which means market goes up and down, you can afford for it to go up and down with it, because you're not drawing from those funds at any stage. And so when you reach 55 and onwards, the purpose of the life cycle strategy, if you will, is to de-risk you, because you're now in a position where you've got that 10-year time frame, whether you are accessing your KiwiSaver, whether it's just going to stay there, but you are getting closer to retirement where you need to protect more of your assets, if you will. You don't want it to drop, and you drop with it and then think, okay, well, what am I going to do now? So we take that approach. I mean, if I break it down quite simply, you've got about 85% of your portfolio in high growth assets, which is the likes of shares, if you will. 10% in our inflation strategy, which is property, infrastructure, utilities. So they're really growth assets, but less volatile, less risky. And then there's 5% in cash and bonds. And so over time, that starts to de-risk you from 55 and onwards. We also believe, life doesn't just stop at 65. So you still need that growth in those years through retirement. That's really important, actually, is that it's still growing while you're still growing. You don't want it to stop. So that's the approach that we take. It is good to spread the myths, so that, when downfalls happen or when something happens, you're not experiencing this full effects of it.
And this point about growth and income, and these are pretty broad terms, right? Growth assets are things like shares and property. So imagine quite a number of you have got significant part of your wealth in growth assets already, albeit they haven't been growing that well in recent years. And income assets are genuinely assets that generate an income, not like rental property, but more like things like term deposits and bonds and cash type investments. So generally, the closer you get to retirement, the more you want to use the likes of those income assets to start to stabilize your total wealth. But one thing to be mindful of is always, we help clients take risk on any given day. It's what our industry is all about. Taking on too much risk can cost people a lot of money if they get it wrong. So understanding your own risk profile and your own tolerance for risk is one really important thing. Before you get into any investment, understanding that and how comfortable you feel with the wiggles and the waggles is really quite important. One thing that I've seen a bit more of in recent years is where people with real wealth have ended up getting caught quite short because of liquidity. And I bet, and Hunter Withers, the team here, probably do a lot of, spend a lot of time helping clients in their businesses think about cash flow and liquidity. But we think about it at a personal space as well. You might have, a wonderful property portfolio, but if no one's buying, then you can't just sell off the garage to pay for that, I don't know, that hip operation that you need, or to help your brother-in-law out with his struggling business. So it's always really important to have some of your wealth in a liquid space, and cash is a good example. You can get that readily. So if something comes up, then you've got a bit of a safety net there. But it is worth noting that if you've got real wealth, then having some of it available and accessible is really, really important. So you don't get caught short. You don't end up having to go to family or class or wherever it might be. I mean, this team can probably talk a little bit more about how long it takes to sell a business, but 84 days is what I'm told. And what we aim to do for our clients is to support them with that liquidity, and they'll have cash assets, they'll have a home perhaps, maybe they'll have some other stuff that's tied up in that classic car collection again, or a business. Often we try and give them something that's going to grow over time, but they can access if the proverbial hits the fan. They need money out for what was it today to loan to a niece for a house deposit. That was my call about an hour and a half ago. So what happens at 65, Jordan?
Does happen. But so so in terms of KiwiSaver, again, I mean, everyone might not have KiwiSaver. It's still so new, and back then didn't really know what to do until now. But at 65, with that KiwiSaver, you are then eligible to withdraw from it. So you have the ability, if you want to take it out as a lump sum, let's say for a large expense, if you will, or you can take it out as a means of income, if you will, where you pay yourself monthly, or you can leave it there and just not do anything with it. So everyone kind of has their own plan. But with that, it's an investment, or it is continuing to grow over time. So again, life doesn't just stop at 65. I had a conversation yesterday actually with someone who withdrew from her fund. She's retired now, and she was quite shocked that within the year, her balance has already increased to the same amount she withdrew from without her contributing any more to it. So that's just the nature of how KiwiSaver works. And yeah, that age of 65, it's just like Reid says, you do need liquidity, and so it is something that you can withdraw from and have access to, which might be a bit easier than selling a house and then sorting that out when it comes. So that's the KiwiSaver, what happens at 65. I'm sure if you've reached there and you do have your KiwiSaver, you're probably well aware that that's what it does. So,
any comments or questions on that? We often get some.
Does that apply to any say a different retirement fund?
Generally, yeah, the SSRS is what you're mentioning. Yeah, the state sector retirement scheme.
Yeah,
I'm not sure what I would imagine it's a 65 eligibility as well.
Yeah.
I would, without looking at the policy wording, it would be similar to KiwiSaver. So what happens is really nothing happens. You've just got you magically have access to that pot now, and it becomes very real because it's not just sort of paper money now. It's something you can spend or not. We encourage, if clients are in a good position. Look, a lot of people, they're not retiring at 65. Maybe they wind down their hours. They drop a day a week, and then next year they'll drop another day. It's not a binary thing now. You're not working in the mines until 65, and then, well, hopefully no one don't really have many 64 mines here in New Zealand. But a lot of people still work past 65. A lot of people still contribute to things like KiwiSaver or SSRS. And that's great. You can continue to build it. Not many employers will continue to contribute to it at that point. Some do, some very generous ones. And that's great because, it's still free money. But ultimately, once you reach 65, you have access to use that money as and when you like. And we encourage clients generally to kind of take regular amounts from it as an income. So if they drop, say they go from 40 hours a week to 10, maybe they're a bit short at the end of the week, and that's where they can draw $1,000 a week or a month or a year from their KiwiSaver to provide a bit of extra income top up. But it's quite flexible. And it's easy enough to get money out. Tax efficiency. There's no capital gains tax in New Zealand.
Yes.
There's always someone who's going to say that. Yes. No, I know, but you know, the political will is just really not there at the moment. Plus, for what it's worth, my thoughts, there's about 3 million Kiwis with KiwiSaver. That is 120 billion dollars tied up in it. And you know, you tell 3 million people that they, put a capital gains tax on, their retirement savings scheme. I'm not sure how well it will go down, but right now, generally speaking, if you've got a KiwiSaver portfolio or an investment portfolio for that matter, that's not KiwiSaver related. Let's say you've got half of it in shares, and Ryman and Somerset and Apple and Microsoft and all that good stuff. The reason you invest in those things is because they deliver capital gains. They're companies that do well and succeed and earn more and employ more, and their share price goes up. Generally speaking, that attracts little to no tax at all. Little to no tax. Probably the right way of putting it. Okay. The income side of it, where you've got things like bonds and cash in it, that's generally fully taxed. But for the most part, it's a really KiwiSaver and managed funds are treated very well by the government because naturally the government wants to encourage people to save into these vehicles so that they're off the hook later on in life when they lift the retirement eligibility age, or when they start to water the pension down or do what they need to do. The pension is not sustainable, so there's a bit of tax leniency in this space in order to support Kiwis becoming fully independent of the state support.
Some question.
Sure. Yes.
So if you're taking money out of your KiwiSaver or retirement fund and it's considered income, you're saying it's not considered income, not taxed.
Not taxed. No. So it's being taxed right now.
Yes.
It'll be taxed tomorrow, taxed the next day. It's taxed
At point of entry.
Yeah, correct. It's taxed at the gains that it makes. So if Contact Energy, use a different example. No, Contact's not. If Contact Energy pays a dividend tomorrow, part of that might be taxable, and your KiwiSaver provider or your investment provider, they'll send that little tax portion to the IRD, so you're done. So whatever you draw, I know we've termed it as income here, but not income from tax perspective, more just like a top up to your household money. But that's the beauty of it. Once your balance is your balance, tax is already paid on it. So it is tax efficient. We typically find that our clients pay an effective tax rate of between 10 and 15% on their tax on their KiwiSaver, depending on how well share markets go versus bond markets. But that's really good. It means more in your back pocket. It's a diversifier. Doesn't matter which provider you're with. If you've owned some global shares in your KiwiSaver account this last couple of years, odds are good it's been a better investment than anything else you've held here in New Zealand, which our economy has some headwinds. But the benefit of things like KiwiSaver and managed funds, a lot of it's invested offshore, and US isn't struggling. Your economy is just going double listed. Europe's doing well. South Korea is having a phenomenal run. Then you've got other things like gold and copper, and you might have some digital currency in there to spice things up. So you're not just dependent on the success or not of our little old. Our economy is worth 0.03% of the global economy. So where you can have some of your money sensibly invested into different areas, then sometimes it works really well. And then from an asset planning perspective, I'll make just a quick note on this. KiwiSaver is yours. It's not anybody else's. Can't be jointly owned. So one of the limitations of holding KiwiSaver post 65 is that if John with a $50,000 KiwiSaver balance pops his clogs, money doesn't just seed to Mary. it goes through, through the estate and through probate, and that can take months and months and months. So there is, from an estate planning perspective, often something we raise with clients to say, if he's got 50,000 and she's got 250,000, maybe it makes sense to actually take that money out of KiwiSaver and put into something that can be jointly owned, similarly invested. But if one of them passes before the other, likely, then the ownership moves to the next spouse. Boring, but important. Any comments or questions, or good, or anything else to add to those points?
What's the average KiwiSaver balance in New Zealand?
Have a stab at it. Stab at it.
Second one.
Lower. Anyone else?
48?
Lower. Higher than 20.
85.
35. Close enough.
Oh,
Yeah. Yeah. So we've got a lot of catch up there if we want to catch. If we're going to flip those Aussies, right?
Yes. Good question. In terms of, we may cover this through, contributions typically would be 3% from the employer and 3% is a standard default.
Yeah.
The Aussies are 12, 9, 12.
12.
Yeah,
12.
12%.
Yeah.
And the land of the living at the moment. Is it in your advice generally with a lot of Kiwis talking about their planning, thinking about contributing a little bit more?
Yeah, absolutely. Yeah, absolutely. And it's I think, to your point, Australia, the minimum is 12. US, Europe, 11, 12 is the norm. Their industries are far more mature and developed now, and their balances as a result are much larger. 250,000 is the typical Australian superannuation size. But it starts when people are really young and they've got the ability to put not just 3% away, but 6 or 8 or 10. And these numbers don't sound like big differences, but when you compound those savings over not just years but decades, the difference is just night and day. So I tell all my clients to tell their children to just start with 10. And if they do nothing else as a 25-year-old with their first job, or 21-year-old with their first, if they do nothing else, it's set for life, because you can't break that a little bit, but often into growth assets like shares and property. It's just, that is just a recipe to compound and build wealth, over decades, not just yet.
I'll jump in because that's something that I cover off with all my clients, is that the recommended percentage to save in your working years is 9%. So if you would save 9% of your earnings until the age of 65, you fully fund your retirement without having to rely on property, without having to rely on, which the younger generation don't have, or it's getting really hard too. So 9%, that is a high number. Again, Australia is 12, so it's not as scary. But when you break down the 9%, if the employer is obliged to do 3%, that leaves yourself with about a 6% bridge. Also, maybe good news is that the government are changing those percentages in years to come. So right now, the minimum is 3. Next year, it goes up to 3.5%, and that's for both yourself and the employer to do. And then in 2028, up to 4. So by that point in time, that's an 8% contribution. And I take that through with my clients because we can actually see what the numbers will look like. And the jump is huge. I mean, a couple of 100,000 sometimes just from another 2%. So that's kind of the numbers, whether that applies to yourself, children, family. It's just good to remember that 9%. And like I say to all of the younger clients, save as much as you can while you can. And then once you start paying off your mortgage, it's not as possible. So then you drop it down. Like, it doesn't have to be, and you're saving for the long term, but you don't want to take away from life today. But that 9% is that sweet spot that we've been seeing as it stands. Yeah.
Any other questions? No. Just the question on keeping that. What's keeping it out of the rural, Mike?
In terms of private?
Because you can tell about not very big enough
How long does it take to sell a farm?
Yeah.
Ballpark figures? I don't know.
Depends.
Speed of the season,
Yeah,
isn't it?
depends on the
Probably
Not long now, but a couple of years ago, it was, yeah.
Sure.
So,
It's probably that I think that as our industry grows, currently the focus is on what we call publicly listed assets. So everything in our scheme, you can sort of log into the Chicago Mercantile Exchange and you can see what the price of copper is right now. You can log into New Zealand's debt market, you can find out what that infratil bond's paying, what it's valued at right now. Or you could log into dial up the NASDAQ, you could find out what I don't know, Nvidia is trading. All of these things are listed on a market that moves up and down every single day. So they've got each and every one has a price every single day. That is share markets and bond markets. With private assets like farmland, if John's turned 65 and he wants to pull out that 50 grand to buy another classic car, how are we going to work out what his share of that farm is? Because we can't just get that farm valued every single day with reliable numbers. So private assets are a little bit tricky when when everyone owns a share in it and you can't necessarily get a price for that asset every single day. So I think there's definitely a space for it, and I think our industry needs to mature and grow and to be able to support local infrastructure projects and big farming developments, etc. I think there's a time and a place for that. But right now, we need to make sure when our clients come to us and ask for money out, we give them exactly what their money is worth, rather than having to sell a portion of a farm to have them get their money out. So does that answer it?
yeah, it does, but that's the reason the Kiwi Bank is relatively irrelevant is just because of that fact, isn't it?
Yeah, especially the likes of share milk. Yeah, the share milkers, I've got some share milking clients. Their house is their livestock, right? But the rules are really, really clear. It's it's a home and that's it. So there are limitations to it. It's not perfect, but they're going to draw a line somewhere and then opened up to, well, what about other businesses, not just farmland? So it's not perfect. Comments or questions? No? Okay. We've done that. So what I want to show you is I've just put together here we go. Good. So fictional plan for Alan and Jenny. This is what we call our financial planning software. We help clients basically in two camps. Those that are accumulating their wealth, still working. And for them, what we try and achieve is we try and give them, based on their expected retirement ages, their expected spending, budgeting throughout retirement, their current asset positions, including KiwiSaver, property, any future money, any spending goals, anything they have existing outside of KiwiSaver. We try to give them a target and say, 1 million is your target. Once you get to that, that's when we can be pretty confident that you've got a big enough nest egg to retire on your terms. So that's something we do for the accumulators or savers. And then what we do for the spenders is we put together a model to show them, based on what they have, how long realistically do we think their money can last them. So what we do is we want to naturally understand their ages and when they plan on retiring. Is it next year, or is it, let's say for this chap, 2 years away? And they've got short life expectancies. They bump those up a little bit. 87, it's probably feels about right. She's got your 87. She's got the gender advantage, so she might make it to 90. What we want to do, and we do think about tax as well. So the tax on we talked about tax efficiency. One thing I didn't mention is that the tax for the likes of a managed fund or a KiwiSaver product, it's not 39 like your trust, it's not 39 like your big earners, it's not 33, it's not 30, it's 28, full stop. So helpful. Most retirees would be on a 17.5% tax rate.
Yep.
Now, going through a budget, nobody wants to go through a budget except those people who Excel spreadsheets, with granular detail. It's like this fella. But it's really, really important, huh?
Engineers.
The grain.
Engineers, okay, fair enough. Look, it sounds really simple, but when you're trying to work out how you can fund your retirement, the start point is understanding what a good year of spending looks like. Like, what does life cost you? Not many people actually know. I mean, we've had horrendous inflation, rates and insurance and every bill has gone up, groceries have gone up. Mints is almost unattainable now. Like there's so many costs have gone up, but if you know what life costs you right now, like you work out an easy way to work it out is take your take-home salary, less any savings. Generally, what you're left with is your expenses. So working out your household expenses, that if you live well now, then using that number, we won't use 42, bump it up. Most of my clients get by on, let's say, we use 60 grand as a number. It's not a trip to Europe every year. Maybe that's 70. We use 70 grand a year. That's a number. So let's say you've estimated that a normal year in retirement is going to cost 70 grand. But retirement has different stages. So if I retired tomorrow at the tender age of 38, I would go and I'd have a big list of bucket list items that are going to be really expensive. And I want, hike. I want to see the pyramids and then go to Machu Picchu and buy a jet ski and I'll do all those things. That's going to be really expensive, but you're not always doing that. So my older clients have been there, they've done it all, and outside of their health costs, which can start to rise, particularly if you've got some, medical insurance you want to keep, health costs can go up, but everything else typically comes down. You're not flying long haul to Europe to visit the family because who wants to be, bailed up in a tin can like that for 24 hours to get to Europe. So generally the first 5 to 10 years of an active retirement can be a bit more expensive. Yeah. But often your costs start to fall as you get older. 70 might be a good start point, but in later life, 60 might be quite respectable and reasonable as well. Naturally, you've got to inflation adjust it. But we'll come to that. So if you felt did a rough and ready budget, you thought 70 grand's a good year, well, perhaps you feel comfortable relying on the superannuation eligibility, which that's 43 grand for this couple. Both retired, definitely covers the basics for sure. But maybe you would need to find another $26,000, 27, 30, whatever. So where are you going to find that from? And how are you going to find that for circa 20 years for him, and then, Jenny's a few more years. So that's the question, right? But then you've got KiwiSaver, and Jenny's got KiwiSaver. We'll chuck something in here for Ellen. Oh, 55 in here. And you want to think about how it's invested, right? Because if you're planning for a 20-year retirement, the difference between a conservative fund, a balanced fund, and a growth fund could be, again, night and day, right? So getting that right is important. They might have property as well. So I think, a lot of Kiwis want to stay in their existing home for as long as they can, but eventually they might, kids have all left and they've got a big big place and it's a lot to manage, and there's the quarter acre is just a hassle, and lawns every other week, so sure. So maybe they downsize, they free up a bit of, they move into somewhere smaller, easy to maintain, cheaper. And that can be a good way of freeing up some equity. And for a lot of Kiwis, that's plan A. Some it's plan B or plan C if they can afford to stay there. But it's worth thinking about that, because you spend all your life paying down that mortgage, you're building up equity in it, and there's an opportunity for some people to use that equity and go and visit the pyramids and Machu Picchu and all that with that money. Things like inheritance. So, not something that we typically want to rely heavily on. And not something we often know the estimated date for.
Unless you plan it.
Yeah. Unless you have a hand in it, right? Yes, I don't know where to comment good on that.
He's going around for a big Wellington with us.
That's right. Other future sums might be selling shares in a business. It might be selling that classic car collection. It might be, it could be a range of different, could be, lottery winnings.
Yes.
If you're hoping for Plan Z or something. Think about other things that you want to spend your capital, you really need to spend your money on. Once you get into a position where you're really, really confident you've got a big enough retirement nest egg, then often what we're helping our clients think about is, okay, so you've definitely got enough, given what we've worked through and what we know. How about we think about, gifting some money to that niece who's buying that first home, or the brother-in-law who's, struggling with health and business, or just absolutely, going on a tour of the world, a world cruise, or going and buying a kit. So what we try and capture here is other goals that are really, really important to people, not just, funding retirement for 50 years, but what other things are really important to them? Is that batch, the beamer, the barbecue? No, barbecue. How important are those things, and how do we factor them in? Now these clients have a fictional amount with us of circa 500,000. And the KiwiSavers come to 90, so they've got a bit of capital there. And look, I won't sort of talk about how we construct portfolios in this forum, but we put together something bespoke for them, which is diversified and accessible and all that stuff. And then lastly, if we kind of come back to the bigger picture here, we want this couple to be comfortable living off a household income of $70,000 a year. Fortunately, super covers them for 2/3 of that. So they were to draw, say, 27,000. If they were to draw $27,000 from that pot that they have, $500,000, how long will it last? Well, I don't have a crystal ball. I don't know what market's going to do tomorrow, let alone 10 or 15 years' time. But shares have a tendency to do a 7 to 10% return. Bonds have a tendency to do a 3 to 5% return. Defensive shares will do 6 to 8. There'll be different markets, and they'll rise and fall, but over time they deliver. If you look out long enough, they deliver pretty consistent numbers. And perhaps their investment market could be this. Their investment market could be that. This would be a global financial crisis type event. But even with a horrendous start, if they stayed invested, they would be able to draw out at $27,000 per year, inflation adjusted, from their capital, and it would outlive them. And this is kind of a worst case scenario, and this includes fees and tax and all that stuff as well. But on top of that, they're able to, maybe they're able to help the kids out as well. They're in a freehold home and they're maintaining that and keeping it to a really nice standard. They could always downsize, but they perhaps choose not to because we've got enough here. And they can focus sort of less on managing their assets, less on being a landlord, tricky tenants or what have you, and they can focus more on, they can focus less on worrying about money and more on the golden years which they've worked hard to build for. So one thing that we can help clients, we'll go back to a less disastrous market start. But one thing that we try and help clients do is even if, let's say they wanted to spend $50,000 on top of their superannuation allowance, like a 90 grand income, is it doable? Well, could be a little bit touch and go towards the end, but then you've still got heaps of equity in your property, and it's going up over time, so you can access that. What if they're a bit more, what if they're slightly more conservative clients? We want to take on a little bit less risk or dramatically, wasn't up there. I know. Sorry, just forgive me while I move around here. So, if we took on a really aggressive approach, maybe we get a little bit further in. We take on a much more conservative asset allocation. Well, it's going to be a smoother ride, but go figure, it might not last quite so long. So it's about finding that sweet spot of risk with the client. Plan on helping them for 20, 30 years. You're going to see another credit crunch. You're going to see another COVID-19 equivalent. You'll see another, some global conflict that will shape markets. So you've got to get the investment settings right. This is not $35,000 KiwiSaver balance. This is real, really significant wealth. Minus 10% can be a big number.
Just on this, I'm sure there's a lot of people sitting out there going, "Ooh, what about my position?" It'd be quite nice to illustrate that. I'm sure when you've run through a scenario with clients, you can either see the relief come off their shoulders, because they think, "Oh shit, I've got plenty."
Yeah.
Or is there sometimes the other opposite? I haven't got enough.
I had about 2 months ago, I had a client just break down in tears in front of me in our meeting, and it was really, she was quite choked up because she was about 63 and her husband was about 15 years older, so a bit older, and she was on great money. And she had clearly felt this burden of continuing to work because she didn't know when enough was enough. And it had been our third or fourth meeting when working through this, and she'd had a year and a half invested, and she was just overcome with relief because she finally felt she could afford to retire. And they were, like, on paper, they were in a phenomenal position, but without kind of unpacking that properly with someone like me or Jordan, she just kept on working. And she stopped taking on contracts, and she's basically retired now. And we've turned on the tap so that they can basically, as her contract income comes down, they can draw more from this account. But we've been through a bit of a budgeting exercise. We've been through lots of risk testing. But yes, so that's really rewarding. And I think a lot of Kiwis probably work harder for longer than they need to, just because once you've like quit, you've sort of no going back immediately. So a lot of people work longer than they realistically need to. And then for a lot of people, it's, it is a hard reality that, you can't afford to retire now. So, you've got to do another five years at least until you're in an okay position. And, you might only have, and this might be your trajectory, or let's take off superannuation, or that might be your trajectory. So let's just face this head on now and try and do what we can to make things a little bit easier. But not ideal. Let's move away from that. So the levers we can pull: work longer, die earlier, or spend less. Just be really frugal, or maybe you have to downsize because,
Okay.
and you have to downsize in 4 years' time, because you don't want to downsize when you run out of money completely, because then you're not going to get you're going to end up with a forced sale. So often there is a downsize that's possible, and we kind of plan around when we can time that, and hopefully it's not today, but we can wait for these prices to recover in 2 to 3 years' time. So yeah, sometimes it's a really great meeting, sometimes it's a space the facts. You don't have enough money to retire now, given what you want to do, but here's a few levers that we can hold to get you there.
I guess the earlier you get into something like this, the easier it is to illustrate,
Yeah.
where you are, where you want to be, and how to get there.
Yeah. Definitely.
So I guess just encouraging people to say, hey, look, if you're not quite sure about what your retirement's going to look like, have a chat to Reed, Jordan, go through the scenario, and then at least you've got the facts in front of you.
And I'll wrap it up with a
That's one general.
Yeah, sure.
Severance pay that's paid out in a lump sum, is that taxable?
I wouldn't expect so. I'll deposit the tax.
From a government department?
From a government department, if are you saying if it is part of an agreement?
Yes, yep.
In terms of it,
Long service severance payout once a job's been disestablished.
right?
And say you're talking maybe 50,000
Yeah.
would be the payout.
Okay. Depends. I think you have to have a look at the whole package of that, and understand sort of is there a taxing element to it? Yeah, have to be a bit more specific on that one. I think have to have a look at the details.
Well, before I pass it over to Andrew, I'll just say that if anyone wants to go through sort of a personal version of this, then they're welcome to. With myself, I'm out in Franklin, Kowi area pretty regularly, so it's helpful. There's no cost, there's no obligation to it. So, this is a service that we have a particular specialization in, and more than happy to do a 45-minute, hour-long session with you to help you get a better handle on your numbers, and that's just part of our good relationship with unbelievers that we can offer that. So we'll be available afterwards to kind of talk and answer any questions you've got, and if you want to do that, by all means, let us know. Otherwise, we'll talk to a lot of people, I guess. Retirement comes after successful exit, right?
That's right. So I guess Reed's talked plenty about KiwiSaver and retirement and stuff, and there's many pieces to that puzzle. And I guess another important part to that puzzle, is succession planning. So most of you guys in the room here have either been in business or you're now out of business. We might know of someone that's looking to exit their business in the next year or two or the next 10 years. So we offer our succession planning service, which takes, some businesses can take a couple of years to exit from, some can take longer. But what I encourage people to do is start the process and start looking at it earlier rather than later, because some pieces of that succession puzzle can take a while to fit. So this up here, we've got a few stages around defining the goals in that succession puzzle, and then assessing the value of the business. Is there any value in it? Can you sell it? Who are we selling it to? Is it internal, external? What skill sets are missing within the business that we need to fill to allow a nice seamless transition? So that sort of happens with that planning, that approach, and preparing those assets, and then finally you're sort of executing that plan and shifting your way out and someone else in. So it does take plenty of time, some more than longer than others. So just encourage everyone to start early. And if you're thinking, as I say, that this is an important part of your retirement plan, definitely get in there early because markets move. There's always trends. Sometimes it's taking the opportunity now, and rather than waiting a little bit longer. Because as I say, you might be on an upcycle within the industry, so that might be the time to do it as opposed to waiting to the peak when things could easily come down quite quickly. So start planning early, think about it, because it is part of your retirement, and we want to help you extract as much value as you can and enjoy your retirement and potentially have a legacy to pass to your children or other family members. Yeah, but thank you very much, Jordan Reid, for coming along today, and always love listening to you guys. Got a wealth of knowledge in the space, and was a valued partnership that we have, and thank everyone here for coming along. And sorry again about the cozy space we had. Well, you can have something to drink afterwards and a bite to eat, and yeah, stick around, have a chat to Jordan, Reid, myself, Tristan, Deborah, Brigitte, now.
Excellent.
Thank you.
Thank you.
Thank you.
What do you think the biggest challenges are for